Listen up, folks. Time could be running out to lock in a historic yield at public.com. But you can lock in a 6% or higher yield with a bond account. Here's the thing. The Federal Reserve just announced a big rate cut, and the plan is for more rate cuts this year and in 2025 as well. That's good news if you're looking to buy a home, but it might not be so good for the interest you earn on your cash. So, if you want to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade bonds, you might want to act fast. The good news, it only takes a couple of minutes to sign up at public.com. And once you lock in your yield, you can earn regular interest payments even as rates decline. Lock in a 6% or higher yield with a bond account at public.com/investing unscripted. But hurry, your yield is not locked in until you invest. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined as nearly almost always by my good friend Jeff Santoro, the voice of the people. Hey, Jeff.
Hey, how are you?
I'm good. The house is a little bit chaotic right now. My son brought a friend home. My son's 7. Anybody who's ever been around 7-year-old boys knows what that means.
That could explain why you hit the record button and then said to me, I don't even know what this show is about.
Yeah. The math checks out.
So if people wonder where we got the name Investing Unscripted, it's because it's pretty unscripted.
Truth in marketing. That's exactly right.
But we actually do have a show idea. And we did actually kind of plan it, sort of.
We did. No, we planned it. We didn't kind of plan it. And we have a name for it. Becoming the investing butterfly you are meant to be.
That is a terrible, we're not naming it that.
No, we're not. But that's what I'm going to say on this show. The idea for this show was inspired. Who inspired this one?
Me.
Actually,
I don't remember. Actually, no, I don't remember who.
This show was inspired by me, Jeff. One of the things that we talked about is we have these regular conversations around not just planning content, but we're actually friends, air quote, friends, in the real life, in the real life. But, we talk about investing a lot, and we talk about our philosophy, and in addition, talking about companies and stocks. But one of the things that I kind of realized was, since I'm kind of the pro here, the long-term investor, I work in the investing industry. Jeff, to a far higher degree than you do, Jeff, I mean, it's my full-time gig. A lot of the conversations that we've had over the past couple of years have been around my experience and experiences. And with you, we've talked about parts of your evolution as an investor, kind of in fits and starts and bits and pieces across different episodes. But one of the things that we haven't really done is spend more time talking specifically about your evolution, maybe in a whole show. So I'm going to weigh in a lot because I can't not talk.
Yeah, no, we know. Any regular listener knows that is a fact.
But I think this is a good opportunity to talk through your evolution as an investor over the past few years. Something I've said before that I think is absolutely the truth, is that you've evolved far more quickly than I did as an investor. There's a lot of ways we could kind of unpack that one that we're not going to even touch. But I think it is pretty remarkable, the evolution that you've gone through. And let's do that.
I wouldn't say it's remarkable. I think what's interesting, I hope is interesting.
I mean, how bad you were to begin with?
I was not that bad. I mean, come on. I wasn't like YOLOing penny stocks. No, but I think the way I think about it is this, right? So I bought my first individual stock at age 40 in February of 2020. And it is now, October of 2024. And we started this podcast more than 2 years ago. So I've somewhere around half of my stock investing life has been spent talking about my stock investing life on a podcast that a decent amount of people listen to. So I've sort of evolved in the public, and I don't know to what degree I've evolved smartly or successfully is probably partially due to the fact that I've been able to talk about it with you and other people and out loud and get feedback and things like that. And I'm not in my 20s figuring things out. Like, I think if, you made the comment that I've evolved more quickly than you did when you were a beginner, but you were also younger, and it was a different time, and you were a different place in life. And if I had been a stock investor when I was in my 20s, I would have been a completely different uh, type of investor, I'm imagining, right? So even though I was newer to buying stocks, I wasn't new to understanding how the market worked and things like that. So yeah, so let's talk through, and the ways in which things have evolved for me over the last couple years, and I think for you too. It'll be fun to hear, maybe not so much what's changed in your process over the last 4 years, like it will be for me, but over the last 5 or 10 or 15, right? Because you have a longer history with it. So, but before we do that, real quick housekeeping. Just want to remind everyone that we have a newsletter you can subscribe to. We have a YouTube channel you can check out, and most importantly, share the show with a friend. Send it to them if you think this is a great episode, and send it to them if you don't think this is a great episode. Honestly, regardless, just send it to them. And 5-star
It's
ratings.
kind of like if you eat something that tastes really terrible and then you insist that your friends have to try it too.
Right. Like, oh, this is disgusting. You have to try it.
Right.
Yeah.
Right. We're okay with that.
Yeah.
Just as long as you make people try.
Yeah. And then, a 5-star rating on Apple Podcasts and a review, and a 5-star rating on Spotify is also a really great way to help the show. All right. Without that out of the way, Jason, where would you like to start?
So again, I kind of want to do this under the kind of the framework of where you were and where you are, and talk through how that's evolved. I really think, Jeff, I think a lot of our listeners are going to kind of be able to relate to that, maybe see themselves. It's somewhere along that same journey that you're taking, where you are now, or maybe where you started, or somewhere in between. So let's start with just the idea of buying a stock, thinking about making the decision. What do you buy? Last week's show, we talked about finding ideas, right? So let's say, I don't want to rehash that episode, but let's say you found a couple of ideas and they all look interesting to you now. Maybe you own some, maybe you don't, maybe you have a small position in some, maybe you have a large position in some, but they're all compelling to you as buys. How do you make decisions what you're going to buy?
All right. Well, let me start with how I used to buy, and then I'll talk about what I do now and how that's changed. So I joked earlier that I don't think I was terrible as a brand new investor. And I only say that because I was at least smart enough to know that I shouldn't spend a lot of money as a new beginner. Right. So I joke a lot about how I was buying literally $5 worth of companies when I started.
You didn't show up in Vegas with a suitcase with your life savings in cash.
No. I literally started with $50 in a Robinhood account. That was how this whole thing started. And
some of that was free money from Robinhood.
Yeah. Well, no, I didn't get any free money, but they gave me GoPro.
They gave you a share of
something. They gave me
right?
a share of GoPro stock, which I think was trading for $4 at the time or something like that. So
when I opened my Robinhood account, I elected to get a free share of Ford. That is the only share of stock. That is the only share of any stock that has ever been in my Robinhood account.
Well, honestly, so this is a little bit of a tangent, but I think it's worth going into.
We are unscripted.
I actually really liked the Robinhood app, and I think that's part of the appeal, right? It's fun to look at, and it's got a nice user interface, and it was a good place to start. The reason I switched, honestly, was partially because I knew that some of the other options out there had just better research. And because once I got obsessed with the learning aspect of it, I needed a little bit more than just like top 100 lists, which is what Robinhood was providing. And also I wanted access to fractional shares, because I said earlier, I wasn't trading penny stocks. I kind of was not trading, but like I was buying penny stock, because when you start with $50 and you can't buy fractional shares, you're buying things that are $5 and $10.
Yeah. So no buying KNSL Capital or Mercado Libre or Google, Alphabet, I should say.
None of that. None
of those. Yeah.
And I knew fractional share trading was coming to Robinhood, because at that point they were advertising it, and I think I was on the wait list to get it. And I might have even gotten it before I completely switched out of it, but I wanted that sooner. So that's how I ended up with Fidelity, honestly. But anyway, so when I was deciding what to buy when I was newer, it was more about, I want to buy everything. So anything that piqued my interest in any way, I would buy. And I was especially interested in things that I understood and knew. And I think that's probably pretty normal for a lot of people. Like one of the first stocks I bought on my own was Apple. And then I bought, I don't even know, but that was one of the earliest ones because I like Apple and I use their products. And I have this distinct memory for some reason of in college at one point saying to myself, I should figure out how to buy stocks and get Apple because I feel like, you know, that would be a good stock to own.
You were right.
Yes. This is probably 1998, 1999. That would have been a really good time to buy Apple.
Very, very right. Yeah.
So that was sort of like, and there really wasn't much more thought than that. It was how much money can I buy? How much kind of money can I spend right now on this? And even when I got a little bit more grown up, I was still buying tiny amounts of money because I hadn't really fully figured out how much I wanted to be investing or where I wanted to be investing. Now what I do, honestly, if you fast forward to like right now, I've become very, 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 very picky. And I almost exclusively just buy more of what I already own. I think we talked about this last week. I'm probably on average buy 1 to 3 new stocks over the course of like a year. That's how much my pace has slowed in terms of adding new positions. I would be willing to bet I'm going to end up selling more than I buy over the next year because I've lived enough of an investor's life and seen enough things in my short 4 years here to realize you don't have to swing at every pitch. So I've become much, much pickier. So in terms of what to buy, for me, it's almost exclusively just adding to what's in my portfolio. And I have a way of deciding what that is. I do have a pretty short list of stocks that I keep, that a watch list, so to speak, that I'm interested in. Like I've talked about this a bazillion times. I'll keep saying it. The one that I'm dying to buy once I feel comfortable with the valuation is Costco. And then I have some others that I want to keep learning about and keeping an eye on. Like NVDA is one that I've always been really interested in. I haven't been able to pull the trigger on it. And I also haven't spent an incredible amount of time diving into it. It's one of those stocks I have like a high level interest in because I like the idea that we could get more energy from solar. And I like the idea of rooftop solar panels because that feels like, why wouldn't you take advantage of the big fireball?
You're starting to get more kind of skin in the game too. I think you have an electric car now and like all of those.
And I'll never do the roof solar just because it would have to be on the front of my house and I don't want to see that. But that's just a personal choice. I don't mind the way they look, but I want them on the back.
I'm actually really lucky in that regard that our solar panels, the back of our house faces the sun.
So right.
It's really, yeah.
Well,
that's a big differentiator.
The other piece of it too is I'm not interested in shelling out 20 grand or 30, whatever it is to.
You're not interested in saving the world for your children? Okay.
No,
that's fine.
Nope. If you've got my children, you better watch. I can say that because they don't listen to this. So I don't want to keep rambling, but that's kind of where, in terms of what to buy, that's sort of where I am right now. I'm mostly adding to my current positions and being very picky if I add a new company.
Well, just a couple of observations. Number one, the period that you started investing in. We saw the fastest 233% drawdown. I don't know if it was the fastest. I think it was the fastest, even faster than Black Monday back in 87 when the market fell like 27% in one day. And it kept falling, right? It was down more than 30% from the high. But I think it took 45 days or closer to 2 months. And we saw this massive like 34% drawdown in 32 days or something like that. And then the combination of stimulus that started flowing in from the federal government, and the states were doing stuff too, and the fact that there were no sports, there were no like things, and we were all at home. The markets were insane. I've never seen anything like it in my entire life. And
yeah, it was. And what was wild about it for me was like, I'm going to sound like a hipster here. Like I got obsessed with investing kind of before the rest of the world did, it felt like, because
they like Pearl Jam before they sold out.
Right. Like you haven't heard of this thing called investing. But it's true because it was like the middle of February and it was because of a conversation with a colleague. I've told that story before. And then it was like, then the pandemic happens like 3 weeks later and all of a sudden everyone's locked at home and they're like, oh, investing sounds fun. So it was like, I was sort of along for that ride, but not for the same reason that most people were.
You got on the train before then, and you did, right?
Yeah.
But I can tell you this. So I've told my story before about early in my investing career, going to Europe for like 17 days with my wife and making a point to go past. This is long ago enough that you like international rates for data were crazy, and everybody didn't just have an iPhone. This was actually before the iPhone came out. So I couldn't just whip out my BlackBerry and check stock prices. Like I'd have to take a laptop and go to a McDonald's in Paris, which that's what every wife wants to do, is go to McDonald's in Paris, right? Every day.
Yeah. Paris is famous for its McDonald's, I think.
It is. It really is. But no, because I was going through exactly what you were talking about. It's like you want to know what's happening with your portfolio. You want to get out quick if things look bad. You want to get in if your favorite stock idea, you feel like that urgency that it's almost like a physical force pushing you to act. It takes time to, and that's one of the things I was talking about. So it's the difference between you and me in that 4 years is it was really 5 or 6 years into my investing career before I really started to be able to pace myself. And one of the things that I did is building frameworks and a structure. And we've talked a ton about that on the show, to create incentives for me to have good behaviors, and also to create friction to make it harder for me to do things that weren't in my best behavior, like selling my best winner and justifying it, saying, well, it's doubled, so I'm going to take half off the table, which I'm not at a table. It's my investment in a company that I think can grow.
Well, that's
just
where
so I could have money to buy some stupid stock that I think is going to do better.
And I think I think to me, there's two ways there's more than two, but there's two kind of like most commonly expressed ways that I've heard where people sort of get into investing, right? So one is like what I did, which is $50, a Robinhood account, start small and just kind of see what happens, right? And that's what I was doing. I was buying things, I was selling things. I remember that first week, like after I bought my first couple stocks, like every free second I had at work, I was like opening the Robinhood app because I was so fascinated. Like this is how naive I was in terms of like, again, if I had been investing for 20 years in retirement accounts, but I would get a quarterly statement. I didn't check up on it. I had no idea something could go up even 4% in a day.
Right.
Right. And when you're investing in February, March, April, May, and June of 2020 for the first time, things were going up.
The entire market's moving by mid-single digits.
And it blew my mind because everything I was relating it to was sort of like, I was comparing everything in my head to like interest rates. Like I was saying to myself, like, well, I can't get more than whatever it was at that time. I can't get more than 0.75% interest in my savings account. And then when I see like the $4 stock I bought 3 days ago is up 8%, I was like, that's a thing? Like I had no idea. So I feel like, but that was kind of I'm kind of happy I was in such a volatile time because it showed me like what's possible. And then when it calmed down eventually, I was like, oh, okay, that was an outlier.
Yeah.
And then I think there's another way people approach it is typically like, I'm going to do a lot of academic research first. I'm going to read One Up on Wall Street and The Intelligent Investor and whatever. I'm going to read 3 or 4 books, and then maybe I'll buy a mutual fund, and then maybe, so it's like, you sort of like do the learning on the front end and then you go into it a little bit more knowledgeable. And I don't know which is better. It probably depends on your personality. To me, for me, I needed to do it. Like I needed to be buying things and selling things and just kind of experiencing it myself. I think if I had read all the books first, I might have gotten bored and just been like, I'm out.
Yeah.
I needed that sort of like hook on the front end. So,
well, let's circle back to that question. So thinking about your process now, how it's evolved from like, go, grab that, got to buy some, got to buy a little bit, want to buy everything, to where you are now being so much more disciplined about it. What are the factors that you usually kind of come down on when you're looking at multiple positions for different reasons and thinking about maybe like a waterfall of this stock over that stock over that stock? What does that look like?
All right. So I think I've explained this before, but I'm going to do it again briefly. And I'm curious if any listener thinks that my method is stupid. I want to know. I want you to, email
I noticed
us
that you said any listener, not anybody. So you've excluded me from giving you my opinion.
I don't care about what you think.
Well, then I think it's stupid.
So here's what I do. I'll try to explain it succinctly.
Hey, everybody, we'll be right back. But first, a word from our sponsors.
FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that,
They have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellow Brick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. I sort my portfolio based on a quick formula that I have, which is basically the amount I own divided by how much that stock has beat the S&P 500. I believe that's the numerator and the denominator. And it just gives it a number. So it basically, something that has done really well, but I don't own a lot of, will sort to the top. And something that's done very poorly that I don't own a lot of will sort to the bottom. And then it's interesting because that sends like...
So it's like a buy signal. It's like, this stock is a winning stock. It has gone up. David Gardner has talked about this before. That's one of his key indicators,
right,
for a stock that could be a compelling buy.
And I'll give a hat tip to two people, and it ties to David Gardner. This is not my idea. So Brian Withers, who we've had on the show recently, actually just maybe a month or two ago, to talk about how his process has evolved. He made a really great spreadsheet that he gave away for free, or still gives away for free. He gave it to the world for Motley Fool members. And he had a column called the Aziz ratio. And this is because there was a person who wrote into the mailbag for David Gardner's Rule Breaker Investing podcast. And he came up with this, what I just said, divide the position size by the amount is beat the S&P 500. You get this
percentage
number
of your portfolio over outperformance or performance against the S&P.
Correct. And it was his, and then what this listener Aziz said was, I think he said, if I remember, this was years ago now, basically like he literally dollar cost averages in and puts like $1 into whatever sorts at the top every day. Right. So Brian incorporated this in the spreadsheet, and I've always used it. I just think it's a really interesting way to sort. So it's not entirely based on performance, but highlights like where you might want to add money. So it's built around the philosophy of adding to your winners.
Right.
So that's what I do as a first step. And then essentially from there, I make a framework driven, but not rules driven decision based on the valuation of the stocks near the top relative to the valuation I paid for my existing position. So for example, if I bought Amazon twice and I paid 20 times earnings the first time, and I paid 10 times earnings the second time, I have an average on my spreadsheet of 15. And if it falls below 15 and it's near the top, I'll consider adding to it. Does that make sense?
Yes. We also, for anybody listening, we also realize that Amazon has neither traded for 10 nor 20 times earnings in its entire existence. That is what we like to call an example.
Yeah. I had to use very simple numbers because I don't math. And then so I do that for a couple different metrics. It's not just price to earnings. And again, none of it is formulaic, even though I'm using formulas. It's not like, oh, it's near the top and it checks all these boxes. It's an automatic buy. That's just sort of the hierarchy at which I look at them.
Yeah.
And sometimes I don't. Sometimes I go way to the bottom and I say to myself, I think this company, I'm excited about something about this company. I like what management's doing.
You have conviction.
Right. Here's
Yeah.
an example. NVIDIA for me is near the top all the time when I do this sort. It's close to, but not yet cheaper than I bought it for. So I've not added to it in a while. PayPal is near the bottom because it's not done well. And I have not put a lot of money into it relative to the rest of my portfolio. But recently, like not this month, but within the last couple months, I added a bunch to PayPal, even though it was at the bottom, because I listened to the earnings call and I read the last couple press releases and earnings releases, and I updated my spreadsheet that I keep for all my stocks. And I was like, I really like the way this is heading. Like, it seems like they're turning the corner. So again, it's not a rule.
Yeah.
And it's a framework like we've talked about. And sometimes I throw it out the window and I buy by gut feel, you know?
So I'm going to bring David Gardner up again. We've used his talking about averaging up. David Gardner is famous for saying dips only buy dips.
Only dips wait for dips. That's
only
the quote.
dips wait for dips, right? That's
Right.
a good way to put it. I'm going to invert that. I'm going to Charlie Munger invert that. Only idiots only average up. But they're both true, right?
Yeah.
They're both very true.
Well,
and
I
think
remember when I first started doing this, I asked you what you thought about it. And your first response was, I like it. I think it's fine. But my worry is that it'll prevent you from identifying a super undervalued opportunity.
yeah.
Yeah.
And the other risk too is if you're only shopping off the top of that list, you could also just be investing in stocks that have run too far too quickly.
Right.
And we don't know if that's the case with NVIDIA right now because we don't know what's going to happen with the cycle for AI over the next few years. But sometimes that happens and it takes you a long time to kind of grow your way out of those investments. So again, this is where frameworks come in, right? You're not using rules because rules just tell you what to do. And having a framework and frameworks in place, you have a process that leads you to making better decisions.
And I've been burned by my process too. So I have a good example of that. So for like several months, the top sorted stock I owned was Celsius Holdings, the energy drink company.
Yep.
And it was massively, not only did it sort to the top because it had done super well and I had not put a lot into it, it also was cheaper than my average purchase on every metric I track. And I'm not talking like
they started making
1%.
money.
Yeah. And it wasn't like 1% cheaper, 2% cheaper. It was like price to sales was like 40% cheaper and price to earnings was like 60. I mean, it was just like screaming at me for months, like add to this, add to this, add to this. And finally I was like, okay, like I'm going to buy it. And it almost immediately just, so
Right.
I don't know if I would have added to it if it hadn't been constantly sorting to the top with these like percentage is telling me it was cheap or cheaper than I had paid for. So, you know,
sometimes
I don't
that's
know,
a
if I was
lesson you can only learn by experiencing it, right?
Yeah.
So yeah. No, I think that's right.
But that's
so
what I do now. And
go ahead.
I was just gonna say, that's what I do now when I'm deciding like what to add to in my portfolio.
Well, and I think that answers the when to buy too, right? Because you're looking for certain value points. You're looking to add to winning businesses when the valuation gets even better than where you bought, even if the stock price is appreciated and you're averaging up, but also being mindful of keeping a watch list and following the businesses as well to look for those opportunities like what you and I both agree we think could be happening with PayPal, where the turnaround is starting to get traction. They're leveraging the powerful franchise they have and driving better profits.
I would add to the when part too, because I think that's another way
like
that
the
I've
cadence
evolved.
of when you buy.
Yeah, and we've talked about this a lot. Like I went from buying the second the money hit my account, that was like how I started, to every week on Wednesdays. And now I do, I would say probably on average just twice a month. But it's not on a set time or day. It's just kind of, I let it, unless something crazy happens. Like if we have like those 2 consecutive days in the beginning of August when the market dropped a lot, I at least went and looked and I decided not to buy anything. And in retrospect, I probably should have, but I don't pre-plan it anymore. It's just kind of like, when do I have the time to take 20 minutes and look through my portfolio? And sometimes that is only twice a month because you know, when I have time, the market's not open. Oh,
Right.
so I would
Well, and
say like,
that's,
I would say like, for me now, it's just sort of whenever I do is fine. And honestly,
yeah.
if I go through and most of the stuff is just not compelling to me, then sometimes I do a whole bunch of thinking about it and then I don't buy anything. And I wait a week and check in again and see if anything's changed.
So we're coming up on about a year from where you really started making that transition from, you had already made the transition from buying every week to once a month was kind of your goal, to really starting to think hard about wanting to make larger individual investments, invest with more conviction, right? And you've substantially evolved from over there. But my question about that, just kind of laying that history over the past year and a half or so, would you say that changing your habits and changing your process around buying less often, but when you are making those investments, they're larger investments, has helped you with that urge to buy more things more often?
Yes. Yeah. Cause like when you're spending $100, it, I don't know, that's probably a lot to some people, but like for me, for my investing, where I am in life, like that's not an incredible amount of money. It's really easy to be like, screw it, whatever. I'll roll the dice on this because what's the worst that can happen? Like this is less than a half of 1% of, probably even more smaller than that of my like investment portfolio, right? When you start making that individual decision be, even like a 0.5% or 1/3% of your portfolio, then you're like, okay, well, maybe a little less YOLO, but a little more research. So it has made me more careful, more thoughtful, and helped it be easier and make more sense to be more spaced out with it.
Yeah.
But the other thing too is that's tied to that is I know more than I did 4 years ago, and I'll know more 4 years from now. And as I've thought more and learned more about like my overall invested money, right? Not just my tiny little stock portfolio, but my 403B and my wife's 401k and the cash we have saved up and all that kind of stuff. I've more and more come around to I can take more risk with this part of my invested wealth because it is 10% of my invested wealth. Not the kind of risk where like a bad day can send me to zero, but like
Running
I
a more
mentioned,
concentrated portfolio, investing
right?
larger amounts in individual companies, that sort of thing.
Like even the Celsius thing that I just talked about, like I'm bummed out
Yep.
by that. Like I'm not happy that I bought it the day before it proceeded to drop like 50% over the next 6 months or whatever. But it's not going to kill me,
Yeah.
and there's a chance that all turns around, and I'm very happy that I had that amount.
Well, PepsiCo is going to be happy about it
Yeah, I know. That's the
when they eventually buy
when they
it.
buy them out. Yeah,
Yeah.
we'll see.
Yeah.
We'll see how that goes.
Let's look at the other end of investing decisions, and that is selling. So there's the what to sell and when. So at the point you're at in your investing journey, Jeff, if you're selling a stock, I mean, I can only think of, these are the 3 reasons that you and I have talked about you selling a stock. The number one is that you don't want to own the business anymore, right? The thesis is broken. You've lost interest in following it and you never had enough conviction to keep it. So you've chosen, I want to exit ownership of this business. Another one is because, again, we've talked about your style of investing and that it's 10% of your invested wealth is stocks that you're picking, owning like multiples of the Mag 7, unless you're convinced that specific one is going to beat the market because you already own a lot of them through index funds. Owning those doesn't necessarily make sense. And there was a third one, and you've reached a financial goal and you are turning a stock into money.
And I want to hear how you've evolved on selling too. But like for me, whether I was conscious of it or not at the time, or whether I was fooling myself or not at the time, early in my journey, I'm sure I was selling for all sorts of stupid reasons, right?
You were.
Yeah. The price went down or, like that kind of stuff.
Yep.
And I'm not
Me
saying
too, buddy. I can remember doing the exact same things.
And I'm sure I will make that mistake moving forward. I try not to make price or stock performance-based sell decisions as much as I can. And again, that's like it's easier for me to hold something that's gone down 90% if I want to, because again, one stock in my portfolio down 90% is not going to bankrupt me.
Right.
If I had $50,000 in Outset Medical and it went down 90%, I'd be pretty pissed off.
Right.
but I think I have like $1,000 in outside medicals. So that's made it easier to hold on to companies where like, at least I feel like there's something I still want to stick around and watch.
Yeah.
But, you know, to my earlier point about kind of buying everything when I was newer, I still have some, not as many now, but like over the past year and a half, 2 years, I still had a lot of those positions. You know, when I got hired as a contractor for Motley Fool, like one of the benefits we have is we can see like all the portfolio services. So like I took $1,000 back in 2021 and just bought all 40 stocks in one of the services just to kind of experience that.
Not $1,000 each. I want to be clear.
No, a total of
Right, you cut that $1,000 into 40 parts. Yeah.
And I even spent 1,000 over several months. Like I just sort of like took what I was saving each twice a month and just $1,000 worth of that over several weeks into this thing. Right. And I still actually do own some of those positions. Some of them have been stocks I have a high conviction. Like I bought KNSL Capital from that and I love that company. Right.
Yeah.
But the ones I've sold over the past year and a half have just been the ones I bought from that. And I never bought them for any reason other than it was part of the service and I didn't have any, you know, so I'm still sort of weeding some of those out. But sometimes I sell something just because I've learned enough about it that I don't want to own it anymore. Like I get the ick about management or something like that. And I'm just like, no, this is not of interest to me anymore. You know, I'm down to 40 stocks, I believe.
Yep.
And I can see that even getting trimmed further. But I still own, you know, Outset, which is a massive loser. Because I want the company to, like, I still root for it. So I'm going to hold that one and see what happens. So.
Yeah. The only thing that I would add for me, and again, this gets back to that kind of stage in my investing career, and also the fact that I'm managing the vast majority of my family's invested wealth, is I have reached that point where I don't know what the market is going to deliver over the next decade, but I know roughly what I need, right, to hit financial. Like I'm at that point now where I can lay it out. And I've talked about this on the show we did. Jason just bought a bunch of bonds. We laid this out, so I'm not going to get into much detail here, but because I've gotten to that point, I can look at stocks in my portfolio. NVDA is an example where I still see lots of opportunity, but over the next 5 or so years, I still have a lot of question marks and uncertainty. I could see myself exiting my full position or selling another half of it, even knowing that, you know, a year and a half ago, it was the wrong decision, or a year ago, it was the wrong decision when I cut my position in half. Thinking holistically about where I am going forward, I could be completely happy being wrong and seeing the stock continue to march ever higher. But knowing that in my portfolio, it's a 20 bagger, it's done what I needed it to do. Now I can take some of the proceeds from that and start investing it in fixed income or a little bit more secure, yieldy kind of things. Because again, I don't know what the market's going to do. I don't know how AI is going to play out in the near term. I don't even know, you know, what's going to happen over the next decade in terms of who the real winners are going to be from the multiples today. But I know what I need, right? You're not quite there yet, right? Where you're still thinking, you know, in decades and multiple decades, right?
A lot younger than you.
You are younger than me. You're less old.
I'm glad you brought up NVIDIA, because that's a really good example of if the exact same returns had happened in my portfolio with NVIDIA in 2021 as happened in 2024, or, you know, whatever the comparable period would be, I would have been probably itching to sell, but not because of like the reasons you're talking about, just because, oh my God, this is up 500%. Like that's insane. Like there's no way I wouldn't have known enough to know, no, it could 20 bag. Like I wouldn't have known that.
Right.
But you know, when you and I were talking about NVIDIA recently, you know, we talk a lot on this show about saving for retirement, because that's the main reason most people invest. But it's also not the only reason people invest. Like you'll hear stories about people who they've owned, pick the company, they've owned Apple for 30 years and they sell some Apple or all of Apple and they pay for freaking college.
Yeah.
Right. Like that's also why you invest. You know, like
I have a friend that has more than $1 million in Apple wealth because he loved Apple products. Exactly the thing you were talking about when you were in college.
He was smart enough to actually buy it.
No, he was old enough and had enough money to do it. He owned a business at the time and he invested some number of thousands, not even a lot of money, but it was enough that it's $1 million now. And his dividend yield on his cost basis is, I don't know, 30%. It's kind of bananas, but
Yeah.
like it's all about stages of your investing life where you have to make these decisions. So I think that's the key. So that's the what, and I guess the when. So I do want to hear you talk about the when to sell part, because this is probably the thing that I think we've maybe had some of the more fun, pointed, mostly text exchanges, but some conversations about when you're thinking about selling a stock.
Hey, everybody, we'll be right back, but first, a word from our sponsors. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast because your yield isn't locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/investing unscripted. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every single week. From hot stocks such as NVDA and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
So I'm going to pretend like I've evolved as a seller. Honestly, before recently, like I would say like the first 2.5 to 3 years that I was buying stocks, like I was most likely to sell a stock when I was bored and looking at my portfolio.
Yeah.
Right. So day off from work and my kids are at school and I'm just like, let's see what's going on. You know, maybe I'll spend some time doing some investing. And then all of a sudden I'm like, I buy a stock and I'm like, I want to buy more stocks. What can I sell to buy more stocks?
What can I sell to buy?
Yeah. And then all of a sudden it's like, you know what? I always hated this company. You know, I start to make excuses. And, you know, again, I'm sure I will do that again. And I'm sure I'll look back at something I did recently and say, no, that really wasn't a good reason. But for me now, like I'm more likely to think about selling after I've learned something about the company that has prompted me to want to sell. And that learn is not the price movement.
Yeah.
So for example, I think the most recent stock I sold, and it's actually one of the ones I have in the portfolio contest, which is Progeny. It's a company I really like from like the tell the story of the stock perspective, right? They basically, if you have health insurance at your company that includes their fertility benefits, they help people with fertility stuff, right? So that's cool. Like I'm happy that people do that. I have a friend who that's who their health insurance uses for that stuff. And they're actually using them right now to try to have a kid. I listened to the Q2 earnings call back in July or August, whenever it was. And it was just, I got like a weird vibe about Matt. Like it was just the way that the CEO was answering questions. Like he couldn't really answer, he kept getting pressed on why things were happening with the business. And his answer for most things was like, yeah, I don't really know. You know, and I was like, that's weird. Usually they know.
Like you appreciate the honesty, but you're the CEO.
Right. And then, you know, I had gotten some other anecdotal evidence that from someone and I started to develop like an ick about management. You know, I started to I was like, you know, maybe this is not. And so I ended up I sold it. Like again, it was one of those, like, there's plenty of fish in the sea. There's other stocks in my portfolio and I would rather, I don't know if that's the right decision, you know, but maybe it was just like I misinterpreted the vibes and the company's fine. But I at least I'm telling myself right now, and we can come back and check on this if I was wrong, that I had a good reason to sell. And it wasn't because, the stock's down X%. Now I have to be perfectly honest. If it was up 400% in my portfolio, like NVIDIA is, I don't know that I would have sold it, if I'm being 100% honest, because that's a lot harder thing to do, I think, is, you know, I would have probably talked myself out of that ick feeling I had, and or said something to myself like, well, I'll keep an eye on it. If it ever gets down near zero, I'll sell it before it becomes a loss.
Well, that's
Um,
one of my favorite things about the concept of averaging up and winners keep continuing to win is that they usually do. Like that is a I don't know what the number is, but it's a bare percentage of stocks like in the major indices like the S&P 500 or Russell 3000 or whatever that create almost all of the economic value. Like it's a small percentage that actually generate the outperformance versus the average. Most stocks go down. Like the average stock loses money. So that's why diversification and being rigorous about picking stocks matters so much. But I think you're right. As a general rule, like selling winning stocks, it's the knee-jerk reaction. Again, that whole I mentioned, like the trader's mentality of taking money off the table. It's the exact opposite of what works because winning businesses generally continue to do it, right? They continue to win and make money and grow over time. So no, I think that's right.
the other thing I think a realization I had to come to was, I think my perception before I started to like really learn about all this was that there was I don't know, like if you were a publicly traded company, you must be legit. Like the idea that like there's just garbage penny stock companies out there, like where they don't really have a business and but somehow people own their stock. Like the fact that companies could come public for nefarious reasons, right? Just to like enrich the share, enrich the CEO. And because there's thousands and thousands of stocks like you've never heard of that are tiny and have basically no business. There was that story a couple years ago about the publicly traded stock. It was just a deli in New Jersey.
Yeah.
So I had no idea that was, I had this like grandiose thing in my head about like what a publicly traded company was. Like, cause in my mind, everything, it's like publicly traded companies are like Amazon and Apple and Microsoft, so I think that was the idea that like I might accidentally own just like a trash company wasn't a thing I believe could be possible when I was new. So, and I probably owned some bad businesses early on that because I just didn't, I thought, oh, it's publicly traded. It's got to be legit. And they're not all legit.
There's one more like when to sell a stock thing that I've come to accept. And that's, I do like to try to find turnaround opportunities when I can. And the problem with the turnaround is you can always find an excuse why it hasn't started working yet. And you can hold that back, right? You can double down on the loser. And I've started to be more rigorous about when there's clear evidence that the turnaround's not working, not falling for the not working yet aspect and moving on. I'll use Walgreens Boots Alliance as an example. That's one that I invested in. I thought the dividend was safe. I thought Roz Brewer was going to be the right leader. She had a great background in retailing, customer service coming from Starbucks. Apparently none of her skill set really translated well, and the business continued to deteriorate under her leadership. They brought somebody new in with a background in healthcare and pharmacy benefit management and all that kind of stuff. And they slashed the dividend. And I made the decision then. I'm like, you know what? It's time to move on. I've been wrong. Maybe they're going to get it together, but let there be signs that things are working before you invest. And if it's taken a long time and there's no progress, move on, right? Move on to better hunting grounds.
Yeah. Cause I think especially with a turnaround, you hopefully buy that company, not just because it has been beaten down, but because you believe there is some thing that's going to happen that's going to turn the business around. And if you have identified that, then you just have to keep an eye for that thing to happen. Like, I'm not trying to brag about being right about Amazon at the end of 2022, but I said to myself, there's no way they're going to continue forever to be operating income negative in the e-commerce business forever.
Yeah.
Like, I get why they are now. They doubled their footprint in 2 years, pandemic, all that stuff. So like, I identified that was the thing I thought could turn around. And so I think if I had seen 3 or 4 quarters later, it was still deteriorating, I would have been wrong. And I like to think I would have sold at that point. So I think you probably went into the Walgreens thing with a similar thing in mind. I think these things will happen. And then when they didn't, it's almost easier, I think, when you're buying something that you think will turn around, because you're kind of forced into thinking about what is the turnaround. Whereas if you just buy a stock that's going up, you're not really worried about as much a specific thing, right? You can get caught up in like revenue growth or something like that, even though you're missing margin compression or something like that.
Yeah, no, that's exactly right. And I mean, it gets just back around to our psychology, right? Where confirmation bias is how we're wired to look for reasons we're right. And we're almost always going to be leaning in towards whatever that our bias is anyway. That really, I guess the core of it is like what you said, looking for reasons that you're wrong, like constantly looking for reasons that you're wrong. And with those turnaround kind of situations, yeah, I think it's easier to objectively see them. I think you're right about that.
All right, wait, I'm gonna flip the script here because I want to ask you one of the last questions we have here on our outline, because I'm actually really, I don't think we've ever talked about this. So
Okay.
I've talked a lot about how I'm very nerdy and meticulous about keeping a spreadsheet on every company that I own and updating it every quarter with all the metrics and blah, blah, blah.
Yeah.
And I know you notoriously don't do any of that. I've joked
Correct.
that you are like a raccoon on meth when it comes to investing, and you just randomly go on benders and buy or sell a bunch of stuff once a year, twice a year. But I'm curious, has your method of sort of tracking what you own,
See what you did there. Method.
I was even trying to do that. Has it changed? Like when you were in your first like 5 years as an investor, did you actually track things at all, like more? And you've sort of learned over time, I don't need to pay as much as close of attention because I sort of have the muscle memory to keep track of it on the fly as I go? Or were you always sort of just read it, remember it, move on kind of a person?
Yeah, I've never journaled. And early in my investing career, I was way too, the tail wagging the dog, where the stock price is the tail, right? Where I'm following the stock price and I'm acting too often on what the stock price has done. And then I guess it was 2010, 2011, somewhere around there, we went through a period where coming out of the financial crisis, it was 2011 or 2012, where the economy was getting healthier, but there was like double dip recession was a concern. Do you remember the pigs? Portugal, Italy, Ireland, Greece.
Yeah.
And Spain, maybe, where there was like these companies or these countries are going to go bankrupt. The EU is going to fall apart, right? There were all these real, very serious concerns that were still lingering from the financial crisis. And the market went sideways for a long time. It was just not good. And a lot of stocks that I bought were doing the same thing. And that was when I really realized that I have to find more patience and really start focusing on the underlying business and know what I own. And I was able to start building some conviction based on knowing the companies. And then, it was really, the bottom was 2009, but really when the economy kicked off and the economic results, it wasn't just margin, multiple expansion, like normalization of multiples from those crazy lows during the financial crisis, just to coming back to better. But like real business growth and profit growth was really like 2012 when that really started happening. And luckily I learned that lesson before I just sold everything and did something dumb. And it's paid off. But the way that I've approached, and that started overlapping when I started doing this, started writing. So
Yeah.
even though I don't journal for myself.
Right. You're writing and learning about,
you write, I don't know, 100 articles, 50 articles a month, and you're doubling your output during earnings season. You start really, really internalizing a lot more about the companies that you follow when you're writing about them regularly. But the one thing that I will say I do, and it's kind of tied to what you were talking about with like the Aziz ratio. I don't use the Aziz ratio, but I certainly look at sorting my portfolio based on companies that are largest in terms of the value of my percentage of the market value of my portfolio. And then looking at those companies based on the percentage of cost basis I've invested and say, okay, are there winners that have done really well for me that I have not been, that I need to be owning more of, right? Being thoughtful about that. And then also inverting it and looking downstream. And it's like, okay, these are companies that I've invested a lot in. They've not done well. What did I miss? What did I get wrong? What can I learn from that and apply to making better investing decisions going forward?
Yeah. The reason I wanted to know if you were ever a little bit more of a tracker is because sometimes now I'm at the point now where like it takes me 90 seconds, 2 minutes to just fill in the new quarter's information, right? It's not a time intensive thing. Like it takes a long time to develop it at the front end, but then every quarter it's a few minutes, right?
Yeah.
But there are times when I do it and then I look at it and I'm just like, yeah, everything's fine, right? There's no like deep insight I'm getting quarter to quarter. I'm just sort of like looking at everything and asking myself some quick questions, like, and 9 times out of 10, I'm like, yeah, everything even if things are down and it was a bad quarter, like I know enough to know that that's not a reason in and of itself to sell, right? Because
Yeah.
I remember thinking, it's funny, one of the few times I did journal something, I found it recently. I spent like an hour and I just like really wrote a lot of stuff about NVIDIA. And it was before all the AI stuff. And my concluding little summary was something along the lines of like, not a great quarter, hasn't been good for a little while. I think the business will be okay. It's pretty diversified, so if gaming doesn't do well, but automotive does, or data centers is weak, but professional visualization is good, I think they'll be kind of okay. And it was probably 2 or 3 quarters before like that first huge AI data center quarter.
It's not diversified anymore.
No, I know, but
That's
what I'm
no,
saying,
I'm just saying, but that's how huge this has been.
right? Yes, agreed. But my point is, when I see a quarter that's down, this is why I know not to. Because I mean, I know it's a cyclical industry, but like I've owned companies long enough now that I can go back.
It teaches you patience.
Right. I can go back and see, it went up and then it dipped down for 3 quarters and then it just kind of turned back around because that's how business goes sometimes.
Right. No, that's exactly right. Yeah. I think that's basically it. Any last words before we wrap it up?
No, I don't like that I talked so much on this episode, but if it was helpful for anyone, I'm glad. I think being able to talk through the way things have evolved. I think what's interesting is maybe we should do this like once a year, kind of like check in, because I'd imagine a year from now I'll feel differently about some aspect of this. I think the pace of the change will probably slow over time.
Yeah.
I don't think I'll be as drastically different 4 years from now as I was 4 years ago. Yeah, it's like a verbal journal for me to talk through the way I've thought about stuff. So yeah, hope people thought it was helpful.
A vernal. It was a vernal.
Yes. If you want to call it that, that's fine with me.
I don't. It's terrible. I'm not going to call it that, Jeff. I made a sushi metaphor last time. I'm going to make a booze metaphor this time. I think this is better than the butterfly, right? The metamorphosis of the butterfly. I'm setting it up to sound like it's going to be corny, but I do think that investing over a long time is like distillation. I think you steadily concentrate down to more and more of who you are and your focus and what matters to you and what you're good at and avoiding what you're bad at. I really do. I think it's more of a distillation process than anything.
Yeah. I said I wanted people to reach out if they thought this was, if they had any feedback for the things I talked about. But I would be curious to know from our listeners how much they think they've changed over the course of their investing time. Like, I feel like I've changed a lot. And I don't know if that's just because I have the benefit of talking about it a lot, right? And thinking about it and writing about it. But I'm curious for someone who doesn't have that outlet, has our listeners' processes changed? If anyone wants to, shoot us an email. I mean, we have a mailbag coming up, so this would be a good way to either share and or ask a question. But I'm curious if anyone else has felt like they've changed a lot over the first couple years of their investing or the last few.
I don't know about everybody else, Jeff Santoro, but I'm enjoying watching you process from rot gut whiskey to fine aged bourbon. You just need some more time in the barrel.
I feel like we're going to have a branded whiskey down the road based on this idea.
Ooh, let's make it happen. Okay, friends, as always, we love to give our answers to these hard investing questions. Walk down the journey that we're taking, sharing our experiences along the way. Jeff, I really enjoyed this conversation with you. But as always, got to remind everybody, this is Jeff's journey. These are Jeff's answers. My answers thrown in here too. It's up to you to find your own answers to these hard investing questions. As always, I believe in you. You can do it. Okay, Jeff, we'll see you next time.
See you next time.